stocks in the long run will be the best hedge against inflation. Doesn't mean that they'll preserve your purchasing power, but they'll preserve it more than buying a rock or buying an entry on the blockchain.
This is the Door Roller Money Podcast. I'm your host, Rob Berger. Today I have the pleasure of speaking with Spencer Jakab. He is an award-winning journalist. He's written for the Financial Times, Dow Jones, the Wall Street Journal. He's currently the editor of Heard on the Street column, and he's also the author of a new book, The Revolution That Wasn't: GameStop, Reddit, and the Fleecing of Small Investors. Spencer, welcome to the show.
Thank you for having me.
Well, I want to sort of dive right into the book because, you know, when it was unfolding, the whole GameStop and I guess AMC, it was told by a lot of the media sort of the David and Goliath story, the retail investor sticking it to the man, sticking it to Wall Street. But at least based on the title of your book, maybe you see it a little differently.
You know, one thing that journalists are guilty of, and it's not bad intentions, is that we write the first draft of history, and sometimes the first draft is a little messy. And during that week, during that crazy week, there were over 1,000 stories that appeared in English over a period of about a week and a half about GameStop. It went from being, you know, just something very obscure to being a major story, to politicians and late night talk show hosts weighing in. And I'll admit that that was my first reaction as well. So it came to my attention a few hours before the first article appeared about it. I've got 3 boys. My oldest boy at the time was a senior in college. He was home because of COVID-19. And I was editing something for the Wall Street Journal the next day. I was also home because of COVID-19. And he said, "Dad, are you going to write something about GameStop?" And I was like, "Well, why would I do that?" And I took a look, and one of his friends had bought the stock. This kid who I've known since he was, lower than my hip, and he was in kindergarten. And I said, "Well, that's great. Looks like he doubled his money." They wrote about it on Wall Street Bets. There's no news. Probably he should sell, because I've seen this happen several times. And he said, no, he's not going to sell. He won't sell until it gets to some huge price, which made no sense to me. And then I started reading the bulletin board, and I saw that they were trying to engineer a short squeeze, or even more than that, to engineer something called a corner, where you force people into very severe losses by forcing the price of a stock up. And that to some extent, they did succeed in doing that. And that was my first reaction too, is this is amazing. This is something that, in my almost 30 years of working in and now writing about finance, I've never seen done successfully. It's something you read about in history books 100 years ago, 130 years ago. It's not really legal to do this, but then who said it would be illegal for a bunch of strangers to get together on social media and do it? But then as the dust began to clear, I started to take a different view of it. And I apologize for being a little bit cynical about it, but it was an amazing episode. It's a crazy story. I love delving into it and retelling it as it happened, and all the things that had to go right for this to happen. But it's also the same old story on Wall Street, which is that people who think that they're smarter than Wall Street usually wind up regretting it. And most of these people will have done so as well. And not only that, but they had 2 goals. A lot of them had 2 goals: kind of sticking it to the man by costing Wall Street a lot of money and making money themselves. And they really, as a group, they didn't accomplish either one of those.
Right. Well, there was sort of an irony there too, because I think, and maybe rightly so, Wall Street can be viewed as, greedy, right?
Yeah.
Broad strokes. But I mean, the retail investors, what were they trying to do? And nothing wrong with it per se, but they were trying to make money. And,
There's nothing wrong with trying to make money. And Wall Street is greedy. But to this generation, Wall Street's more than greedy. Wall Street's like a cartoon villain. You think about what there's people between the ages of 18 and 35, mostly young men, who participated in this, who actually continue to participate in this, because it hasn't ended. There have been subsequent waves of speculation in the meme stocks, and they're big online communities now. But their experience was that they had student loans that they struggled to repay. They were old enough to be aware of the financial crisis. Maybe it affected their parents. Maybe mom and dad lost their house or lost their jobs or something. And they saw, people on Wall Street kind of get away with a slap on the wrist. And then you had this 10, 11-year period where Wall Street was booming and people made lots and lots of money on Wall Street. And it seems like there were no consequences for the people who were at the center of it. And so there's this resentment. And it's not class resentment per se, because it's not resentment of rich people, because there are other rich people who make appearances in my story who are like cheerleaders, who are heroes to this group. So it's not the people with money and without money. It's people who make money by trading pieces of paper and who don't. But that's the crazy thing, is that the people who really made a lot of money on this were mainly on Wall Street. There are a couple of people who lost big. There's one guy I read about who lost $6 billion for his investors. And a couple of other people also had just major, major losses. But, writ large, Wall Street had a pretty good time during the episode that I describe. And that detail, either they don't want to understand it, or it escapes a lot of the people who kind of saw this as a movement.
Yeah, yeah. Robinhood was part of that story, and
Yeah.
shutting down the trading and all of that. And when I talk to folks, one of the things, I'm not a fan of Robinhood, not for that reason. I just think it promotes a kind of investing that doesn't work out well for most people. But a lot of folks say, well, yeah, but the one thing Robinhood does, or a GameStop story does, is it gets people interested in investing who might not otherwise have paid any attention. But my concern is, I'm not sure it is getting them interested in investing. It's getting them interested in sort of, a speculation in the hopes of making a lot of money in a couple of days or weeks.
Mm-hmm.
But that it's actually when they get fleeced, as you suggest in the title of your book, it's actually going to turn them against investing. They're going to actually not be long-term sound investors. What are your thoughts on that?
Yeah, no, unfortunately, I agree with you. And unfortunately, I'm afraid that that's what's going to happen. I mean, let's say that the people, and there are now tens of millions of people who, because of this episode, tens of millions of mostly young people who got into investing in the sense that they have a brokerage account. They got into speculating, most of them not investing, but they got into it because of this episode and because of the events that I described, say, going back 14, 15 months before it, the pandemic and stimulus checks and these, financial influencers on social media and zero commissions and things like that. So what's going to happen to them? I think that it's great to see young people get their foot on the ladder in the sense that they have an account, because young people are just not very interested, in part because of the reasons I mentioned, in contributing to their 401k or opening a retirement account or saving for the long term, or even being lectured about compound interest. My sons, I've droned it on and on and on over the years, so they're all on board, but that they're more the exception than the rule. I hope that when you lose a lot of money when you're early, it's like paying tuition in a way. And I hope that that's it for some of them, that they saw that it was a bit silly what they did. It's like, what, I have this account. I'm just going to buy some stocks and not look at it very often. And I'm going to buy, ETFs, hopefully, and things like that, things that are very kind of sound long-term investments. But I think it's only going to be a small minority that wind up that way. There's another group that's going to quit because they're just embittered by Wall Street. And that will wind up costing them a lot more money over the years, right? Because if you don't participate, what else are you going to do to compound your wealth?
Right.
You can start a business, you can own properties or whatever, but stock market's the easiest thing, the most accessible thing out there to compound wealth over the decades, so you can retire and pay for your kids' education and stuff like that. And it's hard to talk to somebody who's 21 years old about that and express the importance. But of course we know that it is important. And then there's some group of them, and this is the worst outcome of all, who are going to just become degenerate speculators. I think that, if any group of people who walk into a casino and spend some time there, a few percent are going to develop a gambling problem. We're not, it just is going to trigger that dopamine rush for whatever reason, just like substance abuse and things like that. And they're going to be hooked. And casinos, with the flashing lights and everything, they know how to hook people. And so I have a dim view of Robinhood and this new class of brokers because they've adopted a lot of the same techniques, identical techniques that are used on online gambling apps and just in gambling generally, and unleashed it on these people. And so you say that like people, this time is never different. Human psychology is always the same. That's why you have booms and busts, and that's true. I mean, I think that this time is never different in a way, but I think that what's different now is that these companies that make money off of young people trading a lot, they understand human psychology too, and they know what buttons to push. For example, they show you what stocks are, you open it up, they show you what stocks are trending. You make a trade and sometimes confetti will appear on your screen. They'll give you a free share of stock when you open an account, and another free share of stock, like a mystery stock, could be worth a lot in some cases, more than the money in your account when you refer a friend. So it's like a lottery ticket. It's like a celebratory thing. And these are all well understood effects by social psychologists and gambling experts. Even the fonts and the colors that they use are disturbingly similar to gambling apps. And as we know, gambling has exploded in this country. You can't turn on a sporting event without every other ad, or maybe 2 ads in 3, being for DraftKings or FanDuel or Caesars or one of these gambling apps, because there's been an explosion following a 2018 legal decision that's allowed most states to offer sports and even casino gaming through your smartphone. You don't even have to go to a casino. And so if you drew a Venn diagram of young people who were into that and young people who suddenly in 2020 and 2021 got into speculating on meme stocks and crypto, there's a lot of overlap. So that's the thing that really concerns me, is that there'll be a lot of people who basically sort of just continually be these sort of sad sacks who plow their money into the stock market and wind up losing it.
Yeah, yeah. I noticed you wrote an article that you were pointing out that for a lot of these meme stocks, if you're an indexer, and I want to talk a bit about index fund investing,
Yep.
but these indexes, they have to sort of mirror the market, and if the market goes crazy, if one stock goes up, they're mirroring it.
Yeah.
But you mentioned dimensional fund advisors, and I'm a big fan, although I don't have any of their funds. But Rex Sinkfield, who's one of the founders, is a big supporter of U.S. chess, and I'm a big chess player. So, I mean, he's got to be a good guy, right? I mean, that's just how it works.
Of course, yeah.
You mentioned that they didn't have to. Do they run their index funds differently so that they don't have to follow the insanity?
Yes, they do. So, yeah, so they're right now, or maybe not because this is taped a little bit earlier, but just around the time that we're speaking, if you look at a very popular Russell small cap value fund, okay? The number 1 and number 2 stocks in there are 2 of these meme stocks that are by any measure wildly inflated. And that's because they were in that index, they became bloated, and so you still own them. So you can be the most conservative investor and be like, yeah, I'm gonna have my money in this fund that charges 0.03% a year, and it's totally passive. I'm not going to check it. And unwittingly, the 2 biggest investments in that fund are meme stocks that are ridiculously overvalued, that are by no stretch of the imagination are they value stocks, because the indexes are mechanical, and so they get stuff in them. Like an S&P 500 fund, if you think that Tesla's a little silly and you just own an SPY, well, you've got not a small amount of exposure to Tesla because it's one of the biggest weights in the S&P 500. And so are a lot of other stocks that you might be a little iffy about. Dimensional is different in the sense that they have they can have some human intervention in their weightings, and when things exceed the definition of value, they don't have to license the index that they get from a provider like Russell Investments. They can say like, nope, it's gone. And so it was in there, and they got the upside when the meme stock squeeze happened. They got the upside from GameStop and AMC and stuff like that, but then they got rid of it. So it's kind of the best of both worlds. And so it's very interesting that they do that.
Be interesting to see if there's any studies on whether that human intervention over the long term has improved performance or not. I imagine DFA has I'll have to look into that, because on the one hand, that makes all kinds of sense, but sometimes human intervention actually causes problems.
It's interesting because I wrote an article some years ago about magic formula investing. Joel Greenblatt is a famous value investor, has written a few really good books that I highly recommend. And he ran he still runs, but he ran a hedge fund that was tremendously successful in value investing. And for free, he turns out this thing that you can do a stock screener on magic formula investing. And what he said was that using that screener, like they would go through it, and they'd see something that had a lot of hair on it. Like, okay, well, we're going to buy this basket, but not this one. This one is, there was an article in the paper about how these guys are, or this company's in trouble, or these guys are crooks. But whenever they intervened, when they allowed their opinions to override the purely quantitative, judgment of the formula, they did worse. So, human judgment just is not good when it comes to the stock market, unfortunately. I mean, there are exceptions. There are Warren Buffett, and there are people out there whose judgment is very good and whose discipline is there to match. But sometimes a purely quantitative approach is just the best. Just deal with the mistakes that it makes. Especially if you own a diversified group of stocks, if one of them turns out to be Enron or something, it's not going to bankrupt you. It's not like you put half your portfolio into it. It might be 1% or something of the index that you bought, and you'll have a bad day when Enron goes to zero. But the benefits still outweigh the risks of that happening. So it is interesting. I think DFA mainly uses a quantitative screen, and they said, okay, this is not a value stock anymore, so it's out. And they didn't have to wait for Russell to change the index. Basically, that's the difference with them.
Well, and it used to be that you could only buy their funds through advisors and paying the advisor fee, but I think their ETFs now are more broadly available, or at least some of them are.
I think so. I don't know what they cost. I don't have that information at hand, but yeah, it could be better. I'm certainly not out endorsing anyone's financial product over that of another, although I'm kind of unendorsing Robinhood and people like that earlier in our conversation. But in terms of which ETF has the better mousetrap, I don't know. They're all pretty good. I do recommend passive investing generally for most investors.
Okay, well, that's kind of where I was going to turn to, and I think most of the listeners on this show are sort of passive index fund investors. Are you a big believer in putting 100% of your portfolio in passive index funds, or do you have some part of a portfolio that's more active?
Well, I'll tell you what I do personally. If it were possible, I write for the Wall Street Journal. I edit the Heard on the Street column. And so we are allowed to own stocks, but I just choose not to own any individual stocks. I never have during my entire time working at the Wall Street Journal. If I could, because I used to be an analyst, I would basically kind of construct my own stock screen and my own index and just hold those stocks for a long period of time. Because it costs nothing today, really, or very close to nothing to purchase a stock. And an index constructed in that way would allow you to, let's say, like, I don't know, I don't feel that great about Tesla. I don't feel that great about this or that. And construct it in a way that, maybe my judgment would be wrong. I guess it would have been with Tesla, right? But so far, but I could construct my own index. But in addition to that, it's more tax efficient because let's say one of those stocks really goes down. Let's say I have Exxon and I have Kellogg in my portfolio, and then they both go down in a given year. There's a loss. I can take that loss and write it off against my taxes and then buy Chevron and General Mills so that I don't trigger the wash sale rule, which is something that's not really available to you as an index investor. So it's slightly more efficient that way. But I do generally endorse having money in index funds. I have just a couple of active funds. I'm not a believer in active fund management, but I have one active fund that's run by Joel Greenblatt, and I have one active fund that's I couldn't find a low cost passive fund in it, and it covers an industry that I have been a big believer in. And I just set it and forget it. I don't check it, but I'm pretty much 95% an ETF guy. I recommend that to anyone I meet, any neighbor or relative or whatever, is, just have a diversified portfolio and then reweight it too. Reweight it in the sense that, let's say you have just to be simplistic about it, stocks dropped by 30% about in early 2020 when the pandemic began. and you were 60-40 in stock funds, a bunch of stock funds versus a bunch of bond funds. Well, all of a sudden, because bonds rallied and stocks fell, you were 50-50 a month later. If you just circle a date on your calendar and you say, my comfort level is 60-40. I went down to 50-50 because there was this sell-off in the stock market. Everyone's running away from stocks, but I don't know, March 1st is the day that I have circled on my calendar when I rebalance, and I'm going to go back to 60-40, which means selling some of my bond funds and buying some more stocks. And you would have been doing pretty much the opposite of what most people were doing. We can see what happens with mutual funds, the inflows and outflows, and just, lots and lots of money flowed out of stock mutual funds. Lots of money went into treasury funds. You would be doing the opposite, and that would have been a great time to do it. Not that I endorse market timing, but I do endorse this sort of automatic process of rebalancing your portfolio, which allows you to sort of act like a contrarian without having to guess where the bottom or where the top is. It works the other way too. When stocks are off to the races, maybe your weighting in stocks is beyond your comfort level, then you automatically take some money off the table at what might be a pretty good time, right, and put it into something that's a bit more safe. So yes, I do endorse passive investing. I'm not an investment advisor. Let me just say that, but that's what I tell friends and family to do.
Yeah. Well, let's talk about inflation just for a minute, because it seems to be one of the big financial news topics, certainly now and over the last few months. And I'm curious, just your general take on the Fed's response, and then and kind of related to that is, as investors, even passive index fund investors, should we care? I mean, in terms of changes to our portfolio, or should we just largely ignore it?
Well, I think that you definitely should care, because it represents the real purchasing power. So, I mean, you can look at, let's take a look at the 1930s, which was such a horrible time for stocks. It was actually a little bit less horrible because you had deflation for part of that period. So the actual purchasing power of your stock portfolio, it's a small consolation because stocks fell, almost 90% from peak to trough, but went up. And if you look at the 1970s, which were a bad but not nearly as catastrophic time for stocks, your purchasing power declined significantly during the 1970s. So basically the Dow from 1966 to 1982 was unchanged, but it was worth, maybe 60% of what it was at the beginning of that period in real purchasing power, not including the dividends that you received. So inflation definitely does affect you, and that's why you invest. You invest so that you can defer compensation today and then have buying power tomorrow, have savings tomorrow. So how do you react to it? I think stocks actually, despite the 1970s being such a bad time, stocks actually are a pretty decent inflation hedge if you think about it, because companies borrow money, and those borrowings are eroded by inflation. Companies sell things, companies that are able to change prices quickly. Let's say consumer goods companies, supermarkets, people like that. Anyone in the commodity space, in the natural resources space, can reprice and can pass on those price increases and can insulate you somewhat from inflation. Not that inflation is a good thing, but they provide a bit of a hedge. So you see people going out and buying gold or buying Bitcoin or whatever because it's a hedge against inflation. Well, I think that stocks in the long run will be the best hedge against inflation. Doesn't mean that they'll preserve your purchasing power, but they'll preserve it, more than buying a rock or buying an entry on the blockchain.
Well, it's interesting your comparison of the 30s to the 60s and 70s, because when you look at things like how much can you take out each year in retirement without going broke, and Bill Bengen did his 4% research, but retiring in the late 60s was far worse than retiring in 1929. And to your very point, because inflation was just crushing. There was some good in there. I remember 16% returns on my 6-month certificate of deposit in 1982.
Yeah.
Of course, I wasn't retiring then, so I had that going for me.
Totally. I mean, it's there's good and bad in every period. There's always a sort of a silver lining to to everything. But yeah, there are tough periods. And so, yeah, your comfort in retirement, unfortunately, I mean, if you look at any long multi-decade period, of course, then, we could be talking about we could have had this conversation in the 1890s in Tsarist Russia, right? And then you retire in 1917 and all your stock and your house and everything is confiscated. So obviously it's not universally true that stocks are bulletproof, but in a country where we have laws and we have whatever, and we're not going to have a communist takeover, stocks are a pretty good thing in the long run, but it definitely matters what decades you're talking about. You could have been very unlucky and you could have been very lucky. You could have retired in the late 1990s and gone over to kind of a bond portfolio, and you had this massive run up, the greatest bull market really in American history, and then gone into safer investments when yields were still pretty high, maybe bought value stocks and done great. That was a great time to shift from more aggressive to more conservative. And then there are periods when that was the reverse. And inflation matters, but listen, you need to worry about what you can control, not what you can't control, in anything in life. We appear to be in a period of rising inflation that may be, quote unquote, transitory. I don't know. I do the shopping for my family. I have 3 boys and, there are 5 of us and a dog, and I'm one of those people who kind of remembers the last time I was in the store and what something cost. And it's like every time I go, things are more expensive. And so it's transitory. Okay, if prices stop going up by 6 or 7% a year after a few months and they just go back to the way they were, prices are still higher. My standard of living still is 7% lower than it was before, all else being equal. That it's not transitory. It's a permanent hit to my standard of living. So, yeah, unfortunately, inflation does matter. And you need to do what you can do. I do have bonds and stuff like that, obviously, but I've shied away from longer term bond funds, and I have more of a bias towards fairly short term things and treasury and inflation protected securities, because I'm worried about what happens when interest rates eventually have to rise. I'm worried about the ability of the U.S. government to sort of to fund itself ad infinitum after it's taken on all these debts, and I'm worried about resorting to monetizing debt. I'm not a doom monger. I'm not telling you to go out and dig a bomb shelter in your backyard. I'm just worried about the viability of these longer term securities. And so, if you have a mortgage, it's actually good news, because if there's rapid inflation, then the nominal value of your mortgage is being whittled away. So it's a good time to owe money, and it's a bad time to be a creditor, like a creditor to Uncle Sam or to a company when it's a long-term credit. Because if there is continued rapid inflation, then those pieces of paper are worth a lot less in real terms, whereas stocks are more protected from inflation.
Right. Well, let's talk just a minute about crypto. Mm-hmm. And I've been sort of in a fight online, not a fight, but I'm not a crypto fan.
Right.
And but when it seems to go, and of course it's come down here recently, but I mean, when a coin goes like Bitcoin, when it goes from a few $1,000s not that long ago to 70, and of course it's come down, it's hard for anyone to hear the message that this is not a good investment.
Yeah.
And so what's your take? Why do you think crypto, and we can just focus on Bitcoin, I suppose. Why did it see such explosive growth in price? And how do you see this ending or not? Maybe it's the next gold. I don't know.
maybe it's the next gold, but I go on sites like CoinMarketCap and I see that there are like 800 or 900 different cryptocurrencies. Every time I go on there's a new handful that show up. So you could say that maybe Bitcoin will turn out to be some sort of reserve currency or safe haven. Right now it has 2 primary uses. It's used as an object of speculation, and obviously if you bought it when it was at a very low price and still have it now, even though it's dropped a bit, that's great for you. But you have to find somebody to sell it to if you want it to turn it into real dollars. It's a kind of a whole greater field theory. But going back to what I write about in my book about GameStop, and then going back to the sort of the the stage setting that I do, explaining how all this happened, I think they're part and parcel of the same thing. You have this period of zero or very low rates where you can't earn anything on money lying around. And one thing that encourages is sort of, shooting for the moon, these real long shots. Like even investors who aren't 18 years old, people who are 40 years old or 50 years old or 60 years old, you're not making anything on the money that you have sitting there passively. And yet money is extremely cheap. And so things with a very long duration tend to do well. Long duration could be a long duration bond where the payoffs are very distant, but long duration can also be a stock where you have a company that has not made any money yet, but they have a story to tell that it's going to dominate the world of whatever, electric trucks in the future. And then people put these really insane valuations on them. You had Rivian going public with a value of $80-85 billion before having sold a single vehicle.
Yeah,
right. I'm sure it's a nice looking car, but that's double what long established car companies that also have electric vehicles, by the way, are worth. And so crypto, I think, is just in a way, in part, the fascination with it is a continuation of the same thing, because you have something that's kind of like has lottery ticket like elements. If you pick the right coin, if you get in it at the right time. But what you need are these very easy conditions, I think, to continue for most of these to keep rocketing higher. I mean, there is some limit. Of course, I mean, I think crypto altogether today is worth somewhere shy of $2 trillion, which sounds like a lot of money, but it's not a lot compared to the value of all stocks and real estate. What if that was 20 trillion or 200 trillion one day? And it could be, but where's the value, right? I mean, like, there was a time when people traded tulips in the 1600s in the Netherlands, because at least they were beautiful to look at, but tulip bulbs. And at the peak, a certain type of tulip bulb was worth as much as a nice house in Amsterdam that you could live in forever. You're still standing there today. So I mean, it's really impossible to say. You'd have to be the smartest, most insightful person on earth to say when something is going to peak and when it's going to end. And I certainly am not that smart. I can't say. And if I've discouraged people in the past from speculating in crypto and there was some great coin they could have bought and they made a lot of money on, I apologize for being such a curmudgeon. But I don't consider it investing because you can't really say what the intrinsic value is. You can say what the intrinsic value of a house in Amsterdam was in 1630. You can't say what the intrinsic value of Semper Fidelis bulb was in 1630. What happened, which is that it was worth nothing, months later, but that hindsight is 2020. You could have bought it at the right time, so.
Well, yeah, the interesting story here for me is if you take anyone, whether it's crypto, electric vehicles, Kathy Wood and ARK and her sort of approach towards sort of the medical field and technology, and all of these things, for a time, the prices go up. And for each one of them, there's a different narrative. Electric vehicles are the future. Crypto, there's a limit to how many Bitcoin they can mine. And there's always a narrative, and the narrative is factually true. But I think the mistake, I'd be curious if you agree or maybe you disagree, but I think the mistake investors make is they see the narrative as explaining the price movement. When I can't help but wonder if what's really explaining the price movement for all of them is the same thing, and that's fiscal and monetary policy.
I mean, to some extent. I mean, bubbles can happen in the absence of easy money, but they do tend to happen when money is plentiful. I mean, money is what we use to buy these things. You have to put down dollars to buy a stock or buy cryptocurrency or even a tulip, right? People demand money in return, what we consider money, like dollars, a legal tender. And so if it's very cheap to borrow it and it's not very attractive to have it sitting around, then you tend to take big risks. I mean, that I think it's there's no question in my mind that it plays into it. It's one important element of it. It's not the only element because, you read about, I mean, I've always been fascinated with financial bubbles, and you read about the big ones. But then within that, there are lots and lots of mini bubbles that inflate and burst and inflate and burst, all through time, and even when times are sort of bad. And so I think there's more to it than that. There's sort of human psychology and this fear and greed, and some people are in there on the kind of the greater fool theory, and some people are in there just because they're foolish. And I've had many, many, many conversations over the years with people who have kind of come to a sticky end in terms of their investments. And the crazy thing is, like, I was the head of an equity research team at a big investment bank before I retired from that business to become a financial journalist 19 years ago. And I think even then, I think, as a matter of fact, then more than now, even though I didn't know as much as I know today, people would come to me with some investment that they were doing or making and kind of ask me about it. Like around the time of the dot-com boom, I remember like a bunch of my mom's friends were telling me about the internet incubators and this and Lucent and stuff that they were buying, like right near the end. And they're kind of asking you, and I was like a managing director in an investment bank. I was in equity research, so they asked me a question. I'm going to give them an answer and tell them, like, I don't think you should be doing that. You're almost retired and this and that. And do you know what what a PE ratio is? And you know what that's valued at? And for all the, I'm just laying out the numbers and every logical argument that I could make. And then they, what do they say? Oh yeah, well, thanks for telling me. Not a single person says that. They turn around and they're telling you how smart they were because they already doubled their money and they had bought this other thing. And like this sort of, a bull market makes everybody a genius. And what it does at the late stages is it draws in more and more people who have seen other people make money, then they themselves make some money on paper at least. And, that pattern, with or without easy money, will just repeat itself again and again until you kind of run out of someone to sell it to. And then things unravel very quickly. And, the market, they say, the stock market takes the stairs up and the elevator down. The decline is a lot faster than the rise. And, that is a big part of the reason that I'm in this business, actually, is I do it because I like it. It's fun, but that I write things about personal finance because I want to. I know that only a minority of the people who listen to podcasts like this or read my book or articles will sort of see the light, but I hope that enough do, because I've seen so many people, just make horrible financial miscalculations when there were bubbles and mini bubbles. Like I said, I mean, like people who got into 3D printing stocks, 8 or 9 years ago, stuff like that, and then lost a bundle. And, they ask you and then you tell them and then they still do it, or they don't sell, because they're very smart because they made a lot of money. And then they're kind of embarrassed to talk about it afterwards. And they don't take away the right lessons when they wind up losing a bundle on it, which is just right. is frustrating. Although some do, I mean, I'm sure that many people who listen to your podcast have gotten lots of good advice about how to handle their finances and how not to. People are just not wired to do well, if they're very active in their finances, or right. Say 98% of people are not wired the right way. That's not what our brains were designed to do. Our brains were designed to survive in the wild on the savannah and be fearful and greedy. And that just doesn't translate at all to managing our money.
Right. Well, listen, Spencer, thank you so much for your time today. For folks that want to follow you and your work, where should they go?
Well, they can follow me on Twitter at Spencer Jakab. The last name is Jakab. They can go to spencerjakab.com. They can read my articles at the Wall Street Journal. I mainly edit these days, but I do write from time to time. And just look up my name, Google it, and you'll see pixelated version of me, and you can read my articles there, especially if you subscribe to the paper. And it's been a pleasure speaking with you. Thank you so much for having me on.
Well, thank you, Jacob, or Spencer.